How we're going to work through problem 2-3A. Denzel Brooks opens a web consulting business called Venture Consultants and completes the following transactions in March. So as you can see, I've handwritten the accounting equation. Assets equal liabilities plus stockholders' equity. Under each category, I put a T account. I put debits on the left, credits on the right. And then I noted what increases that type of account. Assets are increased with debits and decreased with credits. Liabilities are increased with credits and decreased with debits. And equity is increased with credits and decreased with debits. So we're going to start looking at our business transactions, determine what accounts are affected, what type of account they are, if they're going up or down, increasing or decreasing, and then determine the debits and credits. So for the first one, March 1st, Brooks invested $150,000 cash along with $22,000 in office equipment in the company in exchange for common stock. Cash, which is an asset, is increasing. So when an asset increases, that's going to be our debit. Office equipment is also an asset. It's increasing, so that's going to be another debit. And common stock, which is equity, is increasing. When equity increases, that's our credit. So then we're going to scroll down to the journal entries that have been prepared. So you can see the first one, we're going to debit cash for $150,000. We're going to debit office equipment for $22,000. We're going to credit common stock for $172,000. Proper journal entry format, you're going to put the date. You're going to list all of your debits first and their amounts. And then you're going to indent to list the credit and the credit amount. And then there's a brief description on why you're making that journal entry. These are the account numbers that are used. They are defined in the actual problem itself. This paragraph right here tells us which accounts to use and what the account numbers are. So to continue, number 2, or on the second, the company prepaid $6,000 cash for 6 months' rent for an office. And it does give us a hint to use prepaid rent as our account. Whenever cash is involved, it's easiest to do cash first because it's easy to determine, is cash coming in, it's increasing, or is it going out, it's decreasing. So for this journal entry, cash is going out. We are paying cash out. When an asset decreases, that's going to be our credit. Prepaid rent is an asset. It's something of value. It is increasing. So that's going to be our debit. So we go down to our journal entry. We're going to debit prepaid rent, $6,000. We're going to credit cash, $6,000. On the 3rd, the company made credit purchases of office equipment for $3,000 and office supplies for $1,200. Payment is due within 10 days. So we did not pay cash out. We're going to set up a liability account, accounts payable. So office equipment and office supplies are both assets and they're increasing. So those are going to be our debits. Accounts payable is a liability. We owe someone some money. It is also increasing. Before we made this purchase, we didn't owe them anything, and now we do. When a liability increases, that's going to be our credit. So as you can see, you can keep going back through after you've analyzed the transaction to your accounting equation to determine the debit and credit. This is very foundational for accounting. You have to be able to determine which accounts are debits and which ones are credits. I know it takes some time to kind of go through this, but the more you do it, the more practice you have, the quicker it's going to be. So always go back to the accounting equation if needed to determine your debits and credits. Then when we look at our journal entry, we're going to debit office equipment, $3,000. We're going to debit office supplies, $1,200. We're going to credit accounts payable, $4,200. On the 6th, the company completed services for a client and immediately received $4,000 cash. So we know cash is coming in, it's increasing. We have actually earned some revenue. We completed and provided some services for a client. Oops. So cash, which is an asset, is increasing. That's our debit. Services revenue, that's an equity account. It's revenue, and it's increasing. So that's going to be our credit. So we go down to our journal entry. We're going to debit cash, $4,000. We're going to credit services revenue, $4,000. On the 9th, the company completed a $7,500 project for a client who must pay within 30 days. So again, we have earned some revenue, but they are not paying us now. They're going to pay us in the future. So we're going to set up an accounts receivable. So don't get this confused with accounts payable. Accounts payable is to be paid out. It's a liability. We owe the money. Accounts receivable, the money is owed to us. It's an asset. In this example, it's increasing. So we're going to debit accounts receivable. Services revenue that we have earned is equity account revenue. It's also increasing. So that's going to be our credit. So we're going to debit accounts receivable, $7,500. We're going to credit services revenue, $7,500. On the 12th, the company paid $4,200 cash to settle the account payable created on March 3rd. So on March 3rd, we bought some office equipment and supplies. So we've already recorded that purchase. We set up a liability account, accounts payable. On the 12th, we're just paying what we owe. So it's going to be between cash and accounts payable. Cash is an asset. It's decreasing. We're paying it out. So that's going to be our credit. Accounts payable, a liability, it's also decreasing because once we make this payment, we're not going to owe for it anymore. When liabilities decrease, that's a debit. So our journal entry, we're going to debit accounts payable, $4,200. We're going to credit cash, $4,200. On the 19th, the company paid $5,000 cash for the premium on a 12-month insurance policy. And we're going to talk about our prepaids more in Chapter 3. All you need to know now is that it is an asset. So the accounts affected, cash is decreasing. We're paying it out. So that's our credit. Prepaid insurance is an asset. It's increasing. That's going to be our debit. So we have two assets, one increasing, one decreasing. We're going to debit prepaid insurance, $5,000. We're going to credit cash, $5,000. On the 22nd, the company received $3,500 cash as partial payment for the work completed on March 9th. So looking back at March 9th, we already recorded the revenue right here when we earned it. We set up an accounts receivable showing that we had an asset, someone owed us some money. So on the 22nd, they're just paying us part of what they owe us. We are not going to make an entry to services revenue because it's already been recorded. So we have cash coming into our business. Cash is increasing, so that's going to be our debit. And our accounts receivable is decreasing. That's going to be our credit. The amount that they're paying us, they no longer owe us, so that account's going to go down. And the journal entry is going to be to debit cash, $3,500, and to credit accounts receivable, $3,500. On the 25th, the company completed work for another client for $3,820 on credit. So we have earned some services revenue. They're going to pay us in the future. It was on credit. So again, we're going to set up an accounts receivable. That's going to be our debit because it's increasing. And our services revenue, equity, is increasing, so that's going to be our credit. So we're going to debit accounts receivable, $3,820. We're going to credit services revenue, $3,820. On the 29th, the company paid $5,100 cash in dividends. This is when money is given back to the owners. Cash is an asset. It's going out. It's decreasing, so that's going to be our credit. Dividends are equity. They decrease equity, so that's going to be our debit. Our journal entry is to debit dividends, $5,100, and credit cash, $5,100. You can remember that dividends are always going to be debits. The company purchased $600 of additional office supplies on credit. Office supplies are an asset. We're not paying for them now. We're going to pay for them later. So we're going to debit office supplies. We're going to credit accounts payable. Debit office supplies $600, credit accounts payable $600. In our last transaction, the company paid $500 cash for this month's utility bill. We're going to record an expense. Expenses are always debits. You can memorize that. Cash is involved. We're paying it out, so it's decreasing, so that's going to be our credit. Utilities expense, equity expense. Expenses decrease equity, so that's going to be our debit. Expenses are always debits. You can memorize that. Our journal entry is to debit utilities expense, $500, and credit cash for $500. And that completes our problem.